All right, good morning. Assalamualaikum warahmatullahi wabarakatuh. So in this good occasion, I will record my presentation that I've been presenting on today's class. So enjoy the presentation. Assalamualaikum warahmatullahi wabarakatuh. Good morning, guys. Good morning, Mr. Muslimin. So here are my recordings of the presentation that I just present today. So my title will be Entrepreneurial Venturing and Financing, Chapter 2 by me. And this is the book that I use for this material. Okay, coming up to the first slide, which is our learning objective. So we have 4 learning objectives on this presentation. The first one, hope you guys could identify the financing source available to new vendors and understand the factor that favor one source over another. And the second point of learning objective, hope you guys could understand the source of income of a new venture. And third, hope you guys could recognize the basic attributes of the various financing source and when it's likely to be available. And last but not least, the fourth point is hope you guys could recognize and use the common terminology of the market for new venture financing. Next slide, which is our first material. It's the source of new venture capital financing or angel investor. So angel investor, by the name, we could literally means angel investor, which is an investor that have a good heart, who would invest to your new company. And angel investor is usually individual freelance investor, which are interested in investing very small amounts from 25,000 US dollars until $500,000 US dollar or 500,000 US dollar in the early stage of venture. These angel investors are willing to invest over a long horizon and involve to a quasi-institutional form, which angel acting as a group and may co-invest, often bring significant industry experience and are interested in active involvement. Coming up to the next slide, which is the business angel. It's almost the same like the angel investor, but it's almost different. The term of angel investor purportedly comes from a theater where wealthy individuals took a high risk in funding the production of Broadway shows. And who are BAs or business angels? BAs are defined as high net worth individuals who invest unquoted companies and whose investment are private transaction. That's the key point, which are not subject to any public disclosure. BAs are also referred as an informal investor, given that these individuals typically do not make up a known population and do not rely on a formal institutional infrastructure to support their activities, unlike the VC market, like we just mentioned. And next, we have the figure 2.1. I get this picture from the book, which is a step from opportunity identification until the final step to assembling financial feasibility. So hope you could understand this step of entrepreneurial venture capital activities, which the first step is opportunity identification. It means you need to identify the gap on the business gap, what missing on this business from your perspective. And you need to securing the resource, team building, venture formation, refining your product or service, and last but not least, assembling financial feasibility, which is the final step of the progress. And next slide, we have the source of venture capital, which is venture capital itself. Venture capital is focused on equity investment in high-risk venture with large potential return. Venture capital or VCs funds are organized as a limited partnership or LPs who provide the most of the capital from the general partner or GPs in economic terms. GP is responsible for managing the fund, including the investment selection, working with entrepreneurs, and harvesting the investment. The next slide, we have the source of new financing, which is asset-based lenders. Asset-based lenders or secured lenders are provide that capital to business that have assets that can serve as collateral. We have two things on asset-based lender, which is asset-based lender usually rely on the ability to liquidate business assets from debt servicing if necessary. And according to data from the US, there are estimated around 590 billions US dollars in 2008 in the United States who are asset-based lenders. But I believe this data has been increased and rapidly growth until now 2023 because I only get the old data from the internet and the book. Coming up to the next slide, we have the source of new venture, which is the venture leasing. As an entrepreneur who requires tangible assets can lease rather than purchase them, usually involve assets that are key to the operation of venture. The lessors or the one who gave you the money return may be tied to the financial performance of the venture itself and tax advantage to leasing as compared to owning the company itself. Next, we have another source of venture, which is corporate venturing. We have two things from here. It could be internally managed, like on the right side of my screen, or it could be externally managed, like on the left side of my screen. So internally managed, it means that more likely to occur in firms that depend on innovation to sustain competitive advantage, attempt to keep good idea from escaping. And externally managed, it means that it may seek only financial returns or strategic investment. Next, we have the source of new venture financing, which is the initial public offering or IPO, as we know. I believe all of you guys who are watching this video, this recording, have already know what is an IPO. First sale of equity to public investor, IPO provide a very small fraction of overall new venture funding, and it also provide exit for VCs and other investors in high risk, high growth, high ventures. That's the basic example of IPO. The company raised capital by selling, registering equity and shares to the public via formal offering process. That's the process of IPOs. Coming up to the next slide, we have the figure 2.2, which is the source of entrepreneurial finance. The figure 2.2 I get from the book consists of several blocks, as you could see on the picture itself. The first block, the dark one, is the personal source, public source, and private equity, which could be turned into IPO later on. We have several steps right here. We have bootstrapping, the 3F or founder, friends, family, seed capital, business angel, like we just discussed, venture capital itself, and PE funds, which I will explain on the next slide. Okay, so next we will discuss first about another source of new venture financing, which is franchising. We have so many franchising example on Indonesia, as you could see on the picture in the middle. These are one of the most popular franchiser on Indonesia. We have McDonald's, Pizza Hut, Burger King, KFC's, A&W, and local brand Star 77, which right now we still have not much. And franchising can be enable a business concept to grow rapidly by using capital of franchise. Franchising widely used in fast food and hotel motel industries, and the basic way to describe franchise is an arrangement in which one party or the franchisor permits another, the franchisee, which is us as the buyer of the franchise, to operate the enterprise using the trademark, logo, product line, and also method of operation in return for a fee. So yes, indeed, we pay for those franchising, and it's not coming in the cheap price. It's quite expensive, to be honest. Every brand have different price. So next we have the pros and cons of IPO. So we will discuss from the pros first. The pros of IPO is it is established outside market for the venture shares. It means that people could buy the ventures of your company. Investor could feedback on managerial decisions. It can be used to effect acquisition on the company if you buy the amount of IPO above 60%. And employee stock incentive also comes from IPO. And the cons, we have cons. The cons from an IPO, we have 3 points. The first point is relatively expensive at that time, but right now it's so many. We could buy them. We could buy stocks in a low price, and disclosure requirements, and last but not least, focus on short-term earnings. But in fact, you could do investing on IPO in the long term. It depends on your decision. So what's different about financing social ventures? The difference is we're unable to issue the equity on the company. And the second difference is financing through social ventures is structured debt, royalty based, and philanthropic funding, and may allow investor to make tax deductible or contribution to giving funds, and philanthropic angel investor, as we discussed, and social VC funds, venture capitalizing. Next, we have the information problems facing entrepreneurs and investor. Three basic information of the problem is like this. The information about the value of the opportunity may be incomplete and uncertain at that time but I think it was right now we don't have any problem with that, because on the time right now we are facing the globalization and the revolution of social industry 5.0, which is AI involved or robotic activity involved. So we could get information easily right now. And the risk of appropriation of the intellectual property itself. Coming up to the next slide, which is the source of new venture, which is private placement. Both equity and debt can be issued via private replacement. For example, VC and angel investment. The benefit, it can be faster or less expensive than a public offering, than an IPO, because this is some kind of direct funds. And if you want to compare with IPO need time and mass to build up, to gain up. Sometimes they took years, sometimes they took months. It depends on the company. If we want to talk the case, one of the most fastest growing IPOs on Indonesia are the Gojek and Tokopedia IPO. So Gojek and Tokopedia, or we could say as Goto, when they are opening the company to public, people are just crowdly buying their IPO, because people would think that in the future it will have a higher value than what today. But in fact, the value is already big. They already have a great value, so it would need some new investment or some new invention for Gojek and Tokopedia to evolve to the next level, to a greater value for the IPO. Well, that's the basic example. Next, we have the deal. The deal defined as the allocating of risk and return and the rights of obligation of entrepreneur and the investor itself. The deal is also meant to attempt to resolve information problem on a business. Start with a term sheet which become the basis of the investment agreement between a company. A deal could be described milestone and staging of a company. And a well-structured can create a value for both entrepreneurs and also for the investor. So both parties are having the productivity. Both parties are having their money. And we could say a simple meaning of a deal is as a particular instance of buying or selling. That's the most simple explanation of deal that I could find on the internet. Hope you could understand that. Next, we have the market effect on raising PE investment, which is, I just talked to you guys. I will explain PE after I explain the market effect on raising PE investment. So access to PE raised capital will be influenced by external market condition as well as the investment returns and level profitability being achieved by PE investor. The VC industry is known to be highly cyclical with the periodic change in the supply and demand condition at the time. The PE, or refers to private equity, it refers to capital investment made into companies that are not publicly traded. So it's different between the IPO and stocks and everything. Most PE firms are open to accredited investor or those who are deemed in high net worth, and a successful PE manager could earn millions of dollars a year. So, well, that's a basic example of a PE description. Well, I guess that's all from my presentation recording. So thank you for you guys, the one who listening this video. Go ahead, ask the question in the comment section, because I will try my best to answering your question. Well, I guess that's all. See you on the next presentation and the next video. And wassalamualaikum warahmatullahi wabarakatuh.